Get started. Let's see here. So welcome everyone. My name is Annette Hunt, if you don't know me, and I am a branch manager, loan officer with Guild Mortgage here in Chandler, Arizona. And I am bringing to you today, wow, my slides have decided to have their own mind right now. So, but anyway, I am in Chandler, Arizona. If you are looking to purchase a house here, I am a loan officer, as well as all the loan officers in my branch can help you. If you need any sort of assistance with clients or marketing, I'm sure any of them would be happy to help you. So what qualifies me to give a class on markets and interest rates? Well, I have been in this business since 2004. I've been with Guild Mortgage since 2012, and I started day trading in 2021. So I do that first thing in the mornings when I have time. And obviously, you know, right now it's like 6:30 in the morning, whereas in the winter it starts at 5:30. So I like to get up earlier and do it more in the winter versus the summer. But so far, this spring and summer has been really good for the market. So it's been kind of surprising. I currently manage the Phoenix Tempe branch, and I love it. I love all you yahoos that are in here. It's a lot of fun, and we have a lot of fun. So why does knowing market conditions and why does it matter? Like what is the reason behind knowing all of this as a loan officer? Well, back in 2004, when I started my career, I started it with a bank, and I thought, being in a small town, that being a loan officer, you just had people come into your office and they apply for a mortgage, you give them a mortgage, and then, you know, it's all said and done. You know, the rules were all different back then. I sat there, and believe it or not, business just walked through the door every single day, every day. So 2008, 2009 came along. I held in as long as I could with the bank because I really loved working there. I loved the people I worked with. I loved all of our clients. I knew everybody. So I held in. I was one of the last people standing in all of Northern Nevada. So we had one loan officer in Reno and me in the little town of Elko in the middle of nowhere. That was it in Northern Nevada for that particular bank. I'm not going to say the name. So we'll keep that under wraps. But it was a travesty of what happened to a lot of people during that time period. You know, a lot of people had to short sell, foreclose, they claimed bankruptcy. Like, it was bad. The credit crisis at that time was really bad in the mortgage industry. So I decided to go over to a broker for a builder. We didn't really have any builders in that area, but that broker could do just about anything. You know, right now you see a lot of builders have their own lenders, but they don't go outside of what they already know. Whereas we can, and we did every single day. So they were really the only game in town at the time. And that's where I really started to learn about mortgage-backed securities and the bond market and what to kind of follow. So I had a really surface knowledge. At the same time, I still thought, being a loan officer, you sit behind the desk and people came in, because guess what? They did that there too. They literally would walk into your office and say, hey, I want a mortgage. You know, that doesn't happen nowadays. Back then it was a gift, you know, a gift for everybody at that point. And in 2012, when I was at that broker, we had May. In May, the feds came out and said that they are going to stop purchasing mortgage-backed securities or do quantitative easing. They didn't even start it. They were going to start it months later. But that 1 week period, we went from a low 4% interest rate to into the fives. So it was less than 4 days. I had half my pipeline locked. I had 20 loans in the pipeline. 10 of them were locked. 10 of them were floating. So needless to say, within that 4-day period, I'm praying like, oh my gosh, I really hope that I didn't know any better, right? I didn't know what the market conditions were calling for. And I did not realize that just by the Federal Reserve stating that they're going to stop quantitative easing, that would raise interest rates as much as it did. So I was completely caught off guard. And from that point forward, I vowed to really know these markets, really get to understand what makes rates tick, how they go up and down, and what the current environment is on a monthly, weekly, daily basis even. And this week is no different from the previous weeks that we've had in the last year and a half. So it's going to be volatile this week, and we'll get into a little bit of that. But that's why I have studied and worked on getting to know the markets as much as I have. So factors, we're going to go through factors that affect interest rates, the history of mortgage rates, where our current market conditions are, a future market outlook, how we can help our clients win, and market resources to follow. So first, what drives mortgage rates? So you've got economic data, geopolitics, inflationary pressures, the Federal Reserve, the stock market, and global events. Right now, the biggest thing is obviously we know inflationary pressures, the stock market, the Federal Reserve, they're going to come out tomorrow and raise the short-term interest rate again. Interestingly enough, I wouldn't be surprised if mortgage-backed securities actually get a little better tomorrow after the news is announced, because that's a trend that I have seen since October of last year. So from October to March of last year, I saw that mortgage-backed securities were getting better, even though they were raising the short-term interest rate. So we'll see what happens tomorrow, but that is one thing that I wouldn't be surprised. Whoa. Wow, this thing is going like super fast. Okay, historical rates from the past 70 years. So you can look back here, it should actually say 50 years. I did change that, but obviously it didn't take. But over the last 50 years, this has been where we're at right now. We're kind of like in a median average right now. If you were to take the current interest rate from Mortgage News Daily, these guys have posted this. This is from Friday, so this is Friday's rate, 6.96, and when they post these, they post them every day. This is national, okay, so this isn't specific to Arizona, this is nationally. And up here, you will see the payments in relation to the different loan amounts. So these are the loan amounts, and the source is from Freddie Mac. So I take a lot of stuff from Freddie Mac. They do a lot of really great surveys and things like that. So this is just where we were at historically. Right now, we're kind of in a median range. Like we're in this middle range here. So I don't think that's bad at all for us to be in that mid range. The one thing that's making it hard is the prices of housing right now and how tight our housing market actually is. So, but I'm not surprised that we're in that median range right now. Oh my goodness, I don't know what's going on with this thing. So what I did, since I day trade, I make up a lot of charts. In fact, you know, you guys that listen to me on a weekly basis, you know, I pull up the charts, we look at the charts and see where everything's at. This is a chart that you haven't seen. So this chart shows we have the S&P 500. So the orange line here is the S&P 500, and the blue line is the 10-year bond. Okay. So this is actually TLT. I'm sorry. Let me skip that. So it's TLT, and typically what you see is every time the market goes up, TLT will go down. That's very normal for them to move in an opposite direction. So you'll see this goes all the way back to the 1970s. So I wanted you guys to all see the correlation with what TLT does in correlation with the S&P 500. TLT is another way that I measure rates and where they're going to go throughout the day, which I will bring up a live chart here shortly on that. But if you'll notice right here, right in this area here, this is 2022. This is the start of 2022. And what has happened, sorry guys. So what's happened in 2022 is that TLT has followed the market. It's following the S&P. That is not normal. That is very unusual. And it shouldn't be working this way at all. Just up until recently, you'll notice that the S&P has gone, it's starting to go up. In fact, some investors, some financial advisors that I watch and people that I look at a daily basis, they're saying that we are now entering into a new bull market. So very interesting. So if we're entering into a bull market, and this is where we're at right now, and we've got the TLT starting to go down, what that's telling me is people are buying into stocks and selling off their bonds. So the TLT is a 20-year Treasury note bond ETF, and with it going down, that's actually not very good news for interest rates. So let's move on. We'll talk about that a little bit more later. So where are we going and where are we at now? So a couple of things that are the biggest four factors that I feel like are inhibiting interest rates today. Obviously, we've got the inflation, the Fed's measurement of inflation, employment, investor sentiment, and mortgage-backed security investor risk aversion. So they're completely adverse to risk at this point, and we're going to go through why. I will tell you right now that inflation's coming down. Why they're increasing the short-term interest rate tomorrow is beyond me. I don't understand it. I think that they are doing the wrong thing. I think they need to just keep it steady. They need to just hold rates exactly where they're at and keep trucking along right now. So because inflation started out the same time last year, we were at 9%. And now headline inflation, we're at 3%. Core inflation is what they're concentrating on, but their measurement and what they're measuring for core inflation just keeps changing. They've changed it probably 3 or 4 times. And the reason why they're doing that is because employment is the most important thing to them right now. You got to think, all these federal board people, Jerome Powell, how old are they? Yeah, they're old and antiquated, right? They're looking back to the 70s and the 80s, and we are in a completely different market. There's no reason for them to try to destroy employment right now. Employment is remaining strong. The markets are holding steady. So why mess with it? Why are you messing with it? Because you think employment's going to decrease? the interest rate or the inflation? No, it's naturally coming down on its own with what they've already done. So I think, in my personal opinion, I think they have an old way of thinking about this new market. So here's some talking points and some stuff that they're looking at. The inflation at 2%. They want unemployment over 4%. They want the supply chain to open even further than what it already has. They are looking at core CPI, which is rent inflation decreasing. Now, what is rent inflation and how do they measure it? They measure it from a survey. They call a bunch of people and ask them how much they're charging for rent. Now, tell me that's not dumb. That's like the dumbest thing I've ever heard. But that's literally how they do rent inflation. Yeah, it's crazy. So they're not selling mortgage-backed securities right now, which is a good thing because the market is already stressed in that way. But anything that is falling off the books or expiring, they're just letting it roll over. So they're continuing to do that. And they have said they are going to keep interest rates higher for longer. So they continue to do that. So are they on the right path? So this is one of the charts that I show, the team and you guys pretty much every week. This is mortgage-backed securities. This is literally the MBS, and this is how interest rates are determined daily. And as of, I think I pulled this yesterday, this is where we're at. We're right underneath the 25-day moving average right here. And interest rates at this point are increasing. Anytime we get red candles, that means we are getting an increase in interest rate. Anytime you see the green candles, you are seeing that we're getting a decrease in interest rate. So there was a point I wanted to make on this, and back here is October of 2022. This was the highest point of interest rates. At this point, we were roughly at 7.5% to almost 8% in some cases, depending on the product and program. We could have been solidly in the 8s. Well, since then, we did a really good job of coming up. We were holding steady for a while. And then back in February, the whole month of February was just garbage. CPI wasn't coming down as fast as they wanted it to. And so there was a lot of economic factors that went into the month of February. So we took this dive down. And then we have March. We get into March. Does anyone know what happened in March? Can you remember? Anyone online? Anyone want to put anything online on what you think happened in March? Can you remember what happened in March?
Silicon Valley?
Yeah, Silicon Valley Bank. Yes. Good job, Missy. So Silicon Valley Bank happened in March, and we got a nice little increase in mortgage-backed securities, and we kind of went sideways for a while up until May. So May wasn't too long ago. Does anyone know what happened in May to make us go down the way we did?
Is it another bank closing?
It was actually job numbers. So since May, the mortgage-backed securities have actually really had big reactions to the unemployment and the jobs numbers and jolts and all of that kind of stuff. So we went down in May, then we started going steady in a sideways in June, and then right here at the end of June, we just took a nosedive. Does anyone know what happened there? That was the jobs numbers again. ADP came out with their report for 500,000 jobs created in 1 month. And so that's what started that downward trend. And since then, we have now come up. We had a really good CPI print that helped us out. Tomorrow, we've got the Fed statement. And on Friday, we have PCE, which is personal consumption expenditure, which will make another movement, which should be good. It should actually show up good for the measure of inflation. So that's kind of So you can tell right now, it's all the economic news that's making these rates jump. So the next thing I want to talk about is the spread. So typically, does anyone know what a spread is? Okay, the spread is the gap between the 10-year bond and mortgage rates. Okay, so the 10-year bond right here, we're actually at 390 today. I pulled this yesterday. So actually I pulled this on Sunday. So this is as of Friday. The 10-year bond was at 378 and our interest rates on average were 396. The spread between the two usually should be normally 1.5% to 2% higher, or 150 basis points to 200 basis points in mortgage terms. So, and you'll see mainly that scenario play out for years. You know, you've got this larger spread right here, but that's in 2020. And what this spread is, it's the risk level that the investors are willing to make on the current interest rates. So right now we're averaging anywhere between 300 and 3.25 on the spread. So, but typically at 390, what should our interest rates be right now? In the 5s. We should be in the 5s, high 5s to mid 5s right now. But because investors are risk adverse, anyone that's an investor into mortgage-backed securities, they have decided that, hey, this is too much, it's too volatile right now, we're gonna increase the premium for the rates because we don't want to get squashed. So that's why our spreads are so high. So with that being said, here's the Mortgage News Daily Volatility Index. Now, couple things on this chart, and just to prove the volatility. There was only one little blip just like this one. Can anyone tell me when that was? There's a blip just like that one, that little one right there in the beginning. That was in 2020. This chart went all the way back to 2011, and it looked just like this, except for 2020 had this little blip. So can you imagine? This is what we've been feeling for the last year and a half. And this is why investors are increasing their spreads from the 10-year bond to the actual price of rates. So that's why we see all this volatility it's creeping them out, you know, and rightly so. It creeps us out too, you know. And so you'll also see today's mortgage rates. I pulled this on Friday as well. These are the spreads between the 5-day, 10-day, and 30-day, depending on the day that they locked. So these are some of the spreads with those. But it just gives you a really clear sense of what's happening with those spreads and why our interest rates are still so high. Any questions about that? Did anyone know about that? No? Yeah, because I haven't talked about this yet, have I? So what do we know? We know that economic factors providing headwinds are going to be the Fed's continuing to raise the short-term interest rates. Employment is seemingly resilient. So the Feds aren't really getting their unemployment rate up. They're not getting what they've been wanting to do for the last year. Listings are still at all-time lows. In fact, the lowest in history. Logan Madashami is someone that I follow, and he is so funny. He's on Housing Wire. He has an Instagram profile. He's on Twitter, and he fights the bubble boys every day. And so it's kind of fun to see him actually bring real data, real-time weekly data to prove his point. And so He says there's a savagely unhealthy housing market. And most financial analysts are saying that we're starting in a new bull market and are expecting new all-time highs. So remember that chart I showed you where the S&P was going up and the TLT was coming down? That's actually how it's supposed to work. But what if it reverts back to the mean where we were in 2022? It might mean a good thing for interest rates and for people buying into bonds in the 20-year. I think that's highly unlikely at this point, just kind of seeing what I see, but we'll figure it out. Housing seems to still be accessible versus affordable. So people can seriously access some sort of housing. I can't tell you how many pre-approvals that I've done where people can actually afford the $500,000 and $600,000 house. They just don't want to make the payment. They literally don't want to make the payment. They're approvable, but they don't want that kind of payment. Feds have decided not to outright sell MBS, which we have already talked about that, and banks are still holding steady for now. So the Feds had created, and the Treasury had created a backstop for the banks. When SVB failed, it was because the mortgage-backed securities and the 30-year notes that they were holding were so devalued that the Feds and the Treasury created a backstop for them so they could sell that asset to the Fed and the Treasury for 100% of the value versus the discounted price that they were at. Because people were running on the bank. They needed that money. They needed the asset, and nobody was going to purchase it for 100% of the value. So I would go into the live charts, but we got some time. Okay, so let's go into live charts today. I'm going to pull this one over. Hopefully those of you online can see that. Evie, I know you're on here. Could you let me know if you see this okay? Okay, perfect. Thank you. All right. So this is one of the things that I follow. You guys have seen, the team has seen this many times. This is MBS Highway. This is where we're at today. Anytime mortgage-backed securities are red, that means our interest rates are going up. And our 10-year bond, as I was talking about, on Friday, it was at 378, which was actually a really good measure. I wanted it to stay there or below. In fact, I wanted it to stay below 382. 382 is a key level. And as of yesterday and today, we have crested above that 382. Logan has reported that he thinks that the 10-year bond will remain between 336 and 4.25. So mainly in the higher range for now until the Fed stop hiking interest rates. So that's where we're at today. And then get rid of that. We're going to go to Trading View. This is where I find TLT. So this is another measure or another chart that we look at. Today, TLT is running down to the support level that I've drawn. This line right here is actually a pretty critical level. Anytime that we've gotten underneath that, our interest rates are in the 7s. So just to kind of give you some guidance of where I see interest rates going, when we go back to October, this is what October looked like. So you can see we're not too far from those October lows, which is a little crazy. That's a little nuts, but yeah, we are not that far from October lows. We have a lot of green, but we also have a lot of red. it usually runs about 50-50. So very, very interesting. And
Quick
Go-
question,
cool.
is that in today's market, it's like 50-50, or is that just like historically?
today's market. Yeah, today's market, we're pretty much 50-50. You know, you'll have a string of red days and a string of green days. It just depends on what kind of economic news is coming out. Right now, it's mainly the jobs report that is making TLT drop and the 10-year bond go up. So that's one thing that I will be watching really carefully over the next few months. But good question. US economic calendar. So this week's a busy week. There's a lot of news coming out this week. Like I said, the Feds talk tomorrow, and we've got PCE on Friday. Today was consumer confidence. So consumer confidence came in really big. So it was supposed to be around 112. And so it was actually 111.8 is what they factored it to be. And we came in at 117. So it's pushing the bond prices up and the mortgage-backed securities down. So interest rates are up a little bit today because of it. Tomorrow we get new home sales and the FOMC rate decision. All this stuff all throughout tomorrow is going to be market moving for interest rates. However, like I said earlier, I don't know. Well, of course I don't know. I don't have a crystal ball, but I don't feel that it would be unlikely that our interest rates and our mortgage-backed securities, which would actually go up, and our interest rates come down a little bit tomorrow. But then it's going to flip around on Thursday. Yes. So every Thursday, initial claims come out, initial jobless claims and continuing claims. There is a key level that Logan Matashami is looking for on this, and it's 323,000. If unemployment and our jobless claims increase by 323,000 for a consistent period of time, a short period of time, that could mean that the jobs market is weakening, and that would actually start to help interest rates, which I don't want to see. I want to see people keep their jobs. I don't want to see our initial claims going up and our continuing claims going up. I think they just need to stop right where they're at right now. You know, stop with the hiking. Inflation is coming down. We have the lag effect with the core CPI, the core PCE. Like, there is a lag effect there, and they need to really realize that we're just not in the 70s and 80s anymore, and destroying employment is probably the last thing we should do right now. So those are going to be some big market movers on Thursday. Friday, we have the PCE, core PCE, and then we also have consumer sentiment. So consumer sentiment has been bumping up every single month. So I don't think that this month will be any different. I think consumer sentiment will come in strong, and we'll see another fluctuation in the interest rates again. So I think it's going to bode badly for interest rates. So we'll see how things move along. Lock them while you got them. That's kind of my sentiment for right now. I am going to wait for PCE though. I think PCE is going to be a really good measure. It's going to come in really well, and that would probably boost us up initially for interest rates. So should be pretty good. Any questions about that? Anybody have any questions? No? All right.
Do you go through those, all three of those every morning, or like how often are you looking at that?
Every morning. Yeah, you're absolutely right. Every morning I just scroll through, just kind of check the news, see where everything's at. I usually do it when I do my day trading. Just go in there and look, you know, it just takes a few minutes. So, and then up next, how can we help clients win in this environment? This is the most important, right? A lot of times, and lately, it's still happening. We are still getting seller concessions. So seller concessions are still out there. They're still available because guess what? They have to compete against builders right now. And so in order for them to compete against builders, seller concessions are typically available. Not always, not always. So I will preface that I do know that there are certain areas out there that are getting multiple offers, and it's definitely a seller's market in a lot of cases. But my most recent 3 contracts, I've gotten seller concessions. So, and it helps out in various ways. And Guild is helping out our clients in various ways. And the first thing that we are doing is the 1% down payment advantage program. Like, that is huge. We are giving the buyer $5,000 grant to help with their down payment. And then we're also doing a 1-year buy down. So technically, instead, if we locked the client at 6.625, the first year, so the first 12 payments, they would be making a payment under a rate of 5.625. So, and this is just an example. This is not real, right? So I have to do that disclaimer. This is not real. This is not a real scenario. This is not a real client. And any credit has to be paid by the seller or lender. Okay, that's my disclaimer. But at least this shows you a good example. This is a 2-1 temporary buy down. So if the seller gives enough credit, we could technically do a 2-1 buy down. And so the first year, they would actually be paying 4.625. But if we take into consideration this program right here, you could anticipate that your client would be paying 5.625 the first year, and then their locked rate at 6.625 the second year. And then we've got some new down payment assistance. So these big down payment assistants have just started cropping up because they see the need out there in the marketplace, and their funds have renewed again for this year. These funds do run out. So Newtown is providing $29,000 up to $29,000. It's a 4-to-1 match. And then they also have a different program for conventional only, and it's the ARPA fund where they can get up to $35,000. So they have to apply with Newtown, but it's a great program. Very hard to get a hold of. So they need to apply prior to going under contract. So, and we can help them at least get in touch with them and tell them what to do. But Newtown is very specific that they won't talk to us. They will only talk to the clients. So, and then of course we have the old trusty Home in 5 and Home Plus programs. But Newtown, what is really cool about that is that we could pair that with the 1%, not even the 1%, but just a 3% down program or a 5% down program, and they get locked in at whatever the market rate is. Versus with Home in 5 and Home Plus, you don't have a choice. Whatever the interest rate is what you're going to get. So, and even if the product is available, sometimes they don't have all products available either. So that's why I like Newtown, and what one of the big differences is between our traditional tried and true ones. So things I'm thinking about right now. Any questions about the other programs or anything like that? Okay. Things I'm thinking about right now: can we really avoid a recession and have no landing? I'm kind of thinking that way. Right now, I am thinking that way. Unless something crazy happens. There's only a few things that I think it could be right off the top of my head. But I feel like there's something amiss in the markets. I don't know what it is. And I think it could potentially help us with rates, and it might project us into some sort of recession. But honestly, just looking at everything, I'm not quite sure what that's going to be. Is it possibility? Is the possibility for higher for longer going to come to fruition? I think so. At this point in the juncture, mid-year, looking throughout the end of the year, I think we are going to see interest rates higher for longer. I would not be surprised if we're still in the low sixes by the end of the year. So that's kind of my projection for the end of the year. As long as they don't continue to increase rates. There is a lot of miscellaneous news out there. You know, people are worried about when student loan payments come back into play. I'm actually not worried about that, and I don't think you guys really are either, because we know how they pay student loans, right? There's like 7 or 8 different options for them to choose from. They can do income-based repayment. They could defer the loan again, depending on their situation. They could not even have to pay because of their income. So I think this fear of student loans starting to be repaid, I think it's not necessarily a good reason. So, but there's some talk of that. The other talk that's in the markets right now is commercial loans. Now that is something that I think can actually be market moving if they start to really see big signs of stress with commercial loans. And maybe not so much this year. There is quite a bit coming due in October, around the October time period, but more or less next year. Next year, it's an even bigger pile of loans that actually had come due. And so these commercial buildings, commercial loans, they have to be refinanced. And there's a possibility that they won't be able to refinance. So that'll be interesting. How long before listings start to increase? Wow. I don't know on that. What do you think, Martha? What's your thoughts on that?
That's tough because everybody out there that has the low rates, they are not willing to sell their house. They'd rather stay in, even if it's a bigger house, because they're like, we're gonna sell, we're gonna go to a smaller house, and we're gonna pay more. So why move? So they're not.
Yeah.
They don't want.
Yeah, they don't want to. And believe it or not, right? Their equity is increasing. Our housing's not going down. We're going up. It's amazing. It's amazing. And what were the feds thinking? Like, I mean, you raise the short-term interest rates the fastest ever in history. And you think people are going to sell to get into a higher rate, or that they're going to become distressed and move? That didn't happen. And it's very perplexing to some of them, some of these Fed board members. I've seen some tweets on it. And so I think it's humorous. I'm like, what did you think was going to happen? You know, so it's very interesting. So lower interest rates, are those the only thing that will open up the market a little bit? Possibly. I mean, if we move down to 5.5%, 5%, maybe that might help those people that bought their ugly house in 2020 because they couldn't get into one, you know, and they hate the house. And so maybe that might be a reason, you know. Right now they're living with it because they like the interest rate they got. Yeah. Why do the bubble boys continue with their narrative while the real-time data shows that housing crash is not imminent? So that's always a good one. I feel like that they look at the data, but they change the data to fit their own narrative. And so they've been calling for a housing bust since 2012. So, you know, it's been what, 10, 11 years, over a decade, and it still hasn't happened. And is housing still accessible, not necessarily affordable? I think for now, we keep going on this trajectory. I don't know. I think accessibility is going to start to come down too. Because I know it's not affordable. I mean, what do you think, Martha?
It's not affordable.
Yeah, yeah. So more creative ways to help clients get into a home. So let's compete, right? Let's compete with getting some seller concessions. Let's buy down the rate. Let's do a temporary buy down. One thing that we didn't talk about on the temporary buy down, or I didn't highlight, is that if they don't use some of it, let's say they refinance in a year because it makes sense, the interest rates are 5.5 and they're going to save $500, right? So if they refinance, they actually get a portion of those funds back. Whatever funds weren't used, they can actually put it towards the principal of their house. So that's one of the reasons, you know, to do a temporary buy down versus permanently buying down the rate. And so market mavericks and financial fakers. So I love everybody on the left. Everybody on the left are people that I follow. Housing Wire and Logan. Logan is a part of Housing Wire. He's funny. But he brings the data. He brings the housing news. He looks at the bonds. He analyzes all the data on a weekly basis. Every week he comes out with a weekly tracker. Wealthion has some incredible interviews with some bright economists and economists who are also old. I'm not gonna, there's very few that are in the younger generation below the age of 35. The only one that's below the age of 35 that he actually has on his program, which I need to visit with him about, is this man right here. Reventure Consulting. This is Nick Jurley. Nick Jurley is one of the bubble boys. He has been claiming a market crash for who knows how long. If you've ever watched Tina highlights him all the time. She's with the Cromford Report. It's hilarious. And then of course I watch the Real Investment Show. He's on every morning. He does a live broadcast. He has a radio show in Texas. He is an amazing financial advisor. What he says, I trust. And I think he has just a really good thought process when it comes to the markets in general and investing. So I like him. It's Lance Roberts of the Real Investment Show. Every Thursday on his show, he has his head bond guy on there. And that one I never miss. So Michael Leibowitz. Michael Leibowitz is a great bond guy. In fact, Wealthion has Lance Roberts on every weekend. I watch that show. He's also had Michael Leibowitz on Wealthion as well. Just an excellent bond trader and, you know, forecaster as far as economics and stuff. So really like him. Any questions about that stuff, you guys? No? Cool. And so that's all we got for today. So I appreciate you coming out. And we're gonna actually put this on YouTube. And so then that way you can go back and watch it. So it'll probably show up on the YouTube channel next week. And then I'm also going to put it on our Facebook page. So that'll be fun. Phoenix Tempe branch has a Facebook page, if nobody knew about that. Just so follow us on Facebook. All righty, guys, thanks for coming. And those of you on the live show, I appreciate you coming by and stopping in. And I will see you all later.